Okay, hello everybody. This is Zaheer Anwari from the Traders Cosmos. It's 3 p.m. British summertime. Just double checking to make sure you all can hear me correctly. You can see my screen. If you can just let me know in the chat box if we are good to go. Okay, administrator has told me that sound is good, screen is good. Okay, brilliant. I think we're good to go. Okay, brilliant. Thank you so much. I can see plenty of participants coming in. So really glad to be doing this webinar with you. It's a continuation from what I did last month. So thank you all for taking time out in your busy schedules. Of course, time is our most important commodity. So hopefully you'll get some very good value in return for that today. So in the last webinar, what I'd covered was optimal entry points, how trading requires patience to allow that setup or that entry point to come to you, as opposed to always chasing entries and moving in and out of the market, day trading or scalping. There is a place for that and a style of trading for that suits certain people. But, the facts are very real. Only a small minority of people actually become very successful traders. And so there has to be a certain art to what those 5% are doing. And so following on from what we did in the last webinar, which was all about entry points, today we're going to focus more on strategic exit points. Okay, so first of all, what we'll do is we'll go through a review of my screen setup. So, how exactly does my chart look day to day? Then we'll go through the topic of today's webinar, which is all about systematically placed targets, a summary of the key points, and then, of course, we'll finish off with a question and answer session. Now, if you do have any questions that pop to mind during the actual webinar, by all means, type them in the box. I can see the questions when they come through, and I'll be happy to answer any questions that seem to be relevant at that point. Some of the questions I may wait to the end of the webinar. We'll have 10 minutes at the end to go through any questions that you may have. So by all means, type them in the box, and I will go through them. Okay, let's switch now to my software of choice, which is eSignals Advanced Get. It is specialized software. It does have specialized tools and indicators that are unique to Advanced Get. So you will be seeing some of those. Now, these aren't my own indicators. They do come with Advanced Get. A lot of my own indicators are within the community, and I will be, of course, be happy to answer any questions you have on them. But the indicators that I use on here all come with Advanced Get. Okay, so what you can see in front of you is a very typical chart setup of mine. So at the top, we have the weekly time frame, and at the bottom, we have the daily time frame. And on the left-hand side is my watch list. Now, one thing you should notice is that it is a very extensive watch list. So it goes all the way from the Aussie dollar all the way down to the South African rand, Japanese yen. So I do not limit myself to a single currency, and I certainly don't limit myself to a handful of currencies. A large portfolio is going to do you better than a small portfolio. If you have a small portfolio, what you'll find is that you'll always be looking for trades. When you have a larger portfolio, what you find is that trades come to you. So it's a very different approach. Okay, now I'll start with the weekly time frame. At the moment, what you can see is just a naked chart. Now, I do use candlesticks. That's my preferred choice. And the first two indicators that I'll load up are the 200 moving average and the pink lines. So the 200 moving average acts as a major area of support and resistance. So when price is coming to the weekly 200 moving average and I am looking to buy, then I would wait till we get a break above before entering. And if price is reversing and it's coming down towards the 200 moving average, then I'd wait for a break and close below before looking for any shorting opportunities. So the weekly 200 moving average does act as an area of support and resistance. And you can see that here. This is a very good example. In addition, I have these pink lines. Now, the pink lines represent annual highs, lows, and closing prices of previous years. Okay, so highs, lows, and closing prices of previous year. And they're basically stacked. So here you have the high, the close, and the low of 2013, as we are in 2014. Here we have 2012, 2011, 2010, 2009, and so on. Okay, and so they are the areas of major support and resistance that are taken into consideration. Again, that's a bit of a challenge that many traders face when they first come into trading, which is what support and resistance lines are important and which ones can I ignore. And so I tend to keep things very, very simple. I'm a trend trader. I'm looking for large areas for price to trend in. And so I look for annual highs, annual lows, and closing prices. Okay. And to keep that even, to make that even simpler, I only take the previous 2 years into consideration. So as we are in 2014, 2012, 2011, they are the two pink lines that I take, two sets of pink lines that I take into consideration. The other pink lines then sort of pale into insignificance. So again, I really try to simplify this as much as possible. Now, of course, if a pink line represents a major high or a major low, then of course I would take that into consideration. So if you can see here, this is obviously a major high. Okay, all right, so just a brief, okay, right, okay, so I'll just quickly go through what I said with the pink lines. All right, so basically the pink lines represent annual highs, annual closes, and annual lows of previous years. Okay, and so what we have here is 2013. Here is stacked for 2012. Here it's stacked for 2011. Here it's stacked for 2010, so on and so forth. I only take the previous 2 years into consideration. So as at the moment, as we are in 2014, 2013, and 2012, they are the two sets of pink lines that I take into consideration. Okay, so I try to keep things as simple as possible. In addition, what I was saying about major highs and major lows is that when price heads towards a major high, then I would take this into consideration. So if I'm looking to buy and price is near this level, I would wait for a break and a close above before looking to go long. And if price came towards this low, I would wait for a break and a close below before shorting. So even though I do take the previous 2 years into consideration, I would of course take major highs and major lows into consideration as well. Okay, guys, can you still hear me? Yes. Okay. Brilliant. Yep. Okay. Fantastic. Good. Okay. Thank you. All right. So I hope that makes sense. Okay. So those are the areas of support and resistance that I take into consideration. Right. Let's go down to, and so just to recap, the weekly time frame is what I consider Big Brother. And so Big Brother dictates to Little Brother what to do. So Big Brother being the weekly, Little Brother being the daily time frame. So weekly, I look for trend direction. The daily, I look for entry points, and most importantly is where I manage my stops. A lot of people go down to a lower time frame to manage stops: 4 hour, 1 hour, 5 minutes. You know, some people don't even have stops. That's a critical error. The best place to manage your stops is on the daily time frame, because you can stay in the trades for much longer, and also it allows for compounding. So once you are in a winning trade, you want to add further positions, and so managing your stop on a daily time frame allows for that. Okay, so if we go to the weekly time frame, you can see here it's a very good example of how the trend is up. So this is going back to the middle of last year. So you're looking at June, July 2013, around this area here, and you can see that the trend is very much up all the way through to now. So, you know, it's coming up to a year where the trend has been up. So long is the direction that you really want to be going in. Okay, if we go down to the daily time frame, now I'll load up the indicators on here one by one. First of all, I'll load up the daily 200 moving average. Now, the daily 200 moving average not only acts as a major area of support and resistance, but it also gives me a bias in price action. So what that means is when price is above the daily 200 moving average, that's when I look to buy. And when price is below, that's when I look to sell. Now, this is not a system that I've created myself. This goes back to, you know, the turtle traders, and Richard Dennis, William Eckhart. You know, it's the same philosophy that they used back in the 70s and 80s. Nothing has changed. It's the simple 200 moving average. It can be the exponential if that is your preferred choice. You know, it's not going to make much difference, the simple exponential. I tend to just use the simple for most of the moving averages that I use. Okay, so that will give us a bias in price action. Next, I'm going to load on this filter. Now, this filter basically, again, adds further confluence, and it again gives me a bias in price action. This is XTL, which stands for Expert Trend Locator. It's an indicator, as I mentioned earlier, that's provided by eSignal's Advanced Get. So if you purchase eSignal, you can, eSignal's Advanced Get, you will get this indicator with it. Now, it's a very simple indicator. You just get three colors, which is the red, the black, and the green. When price is green, that's when we're looking to buy. When price is red, that's when we're looking to sell. And when price is black, it basically means an area of consolidation, and that's where you want to be standing aside. Now, remember, trend traders and range traders have a very different approach. Range traders, go short of resistance, long of support, and go, multiple entries in and out. But when a market is ranging, as it is here, this is when trend traders stay out of the market and will either look at another pair, euro dollar, euro yen, pound yen, New Zealand dollar CAD, another pair that is trending, or if a whole market is in a range. So, sometimes, for example, the foreign exchange market, that's been in a range since pretty much January. So we're looking at a good 3-4 months. And that's how long I have actually stayed out of the market. Now, that doesn't mean that I'm not trading. What that means is that I've removed my risk from the foreign exchange market because there's no liquidity in it. And I moved to another market like stocks or commodities where there is liquidity. So again, you don't want to limit yourself to a single market like foreign exchange. You want to have stocks and commodities and whatever else you like trading within your portfolio. A top investor has an extensive portfolio. And again, that could include things like property. It could include things like art, if that's what you enjoy. You've got to have an extensive portfolio because not all things will be returning you money throughout the whole year. It happens in periods. Forex can move for 3 months. Stocks can move for 3 months. You've got to move where the money is. Okay, so XTL is a good indicator because it tells you when a currency or even a whole market's in a range. And that's given by these black bars. Okay, now the next indicator I'm going to load up is Get Stochastic. Again, Get Stochastic does come with Advanced Get, so it is something that you can get with it. And of course, Stochastic, people are familiar with Stochastic, which is an overbought, oversold indicator. So basically, when price is overbought, we tend to see a reversal to the downside. And when it's oversold, we tend to see a reversal to the upside. Now, what happens is that when price is overbought, that's when traders go short. And when price is oversold, that's when traders tend to go long. It's not, it's not the best approach. What you really want to be doing is having an indicator like Get Stochastic. And when Get Stochastic produces this false bar, what it's telling you is to ignore Stochastic and actually go in the direction of the trend. So don't go short, go long because of the black bar. So now let's start adding the logic together. I've got the daily 200 moving average telling me, let me rephrase that. I've got price above the daily 200 moving average. So I'm in a bull market. So I'm looking to buy. I'm now looking for further confluence to add to that. I've got green XTL bars suggesting further strength. Okay, so that's good. I've also got Get Stochastic giving me a false bar reading telling me don't go short, continue going long in the direction of the trend. Right, I've got 3 indicators all adding weight to my understanding of price action, telling me to go long. Remember, guys, by the way, even if you've got Advanced Gets and if you've got all the flashy software and indicators, if you don't have a good solid understanding of price and natural market movement, price is the most important indicator. All other indicators are really insignificant because your trading decision should be based on price first. Other indicators like XTL and Get Stochastic, RSI, whatever, Bollinger Bands, whatever you guys like to use, have to add weight to your price-based decision. So price always comes first. Okay, so that is a typical screen setup. Now let's get into the bulk of today's presentation, which is about systematically placed entries. Systematically placed exits. Okay, so what I covered just now is my screen setup and partially what I did in the last webinar. If you missed the last webinar, I believe it's online, so you can watch it. Okay, so once we've found an entry point, where is it likely to head towards? Where is price likely to trend? And I'm going to keep this very, very simple, guys. Okay, the answer is round numbers. Okay, beyond pink lines, beyond moving averages like the weekly and daily 200 moving average, which can also be potential targets, round numbers act as the perfect target levels. Now, let's try and visualize this. Okay, imagine price is underneath the floor of your room. Okay, so the floor of your room is a round number and it's acting as an area of resistance. Okay, so now there's potentially two things or three things that can happen. One, a bounce and price heads back down. It could consolidate around that level, or potentially it could break through. Okay, so let's imagine price breaks through the floor of your room. So now that resistance has now become support, and that support is a round number. So let's say, for example, 1.6. Where is price now likely to head towards? Well, the answer is, if you haven't guessed it already, is actually the ceiling of your room. Now, the ceiling of your room is another round number. So in this case, 1.7. Okay, is 1.7. So, sorry, I just saw a question come through. I'll answer that in a second. Okay, so the ceiling of your room is the next round number, which is 1.7. So that is your target. That's your mental target for where you want price to head towards. The difference between 1.6 and 1.7 is 1,000 pips. So round numbers tend to have a distance of about 1,000 pips. And those are the targets you should be. Those are the spaces you should be targeting. A target of 50 or 100 pips and then exiting is not going to change your lifestyle. It's not going to change your bank account. You know, if you've got to be smart about this. If you are targeting 50 to 100 pips, what people then tend to do is over risk on their account. So you're looking at large risk, 5, 10, 15, 20% of their account on a single trade. That is a dangerous territory to be entering into. When you're risking 20%, you want to have as many as 20 single positions, all risking 1% each. And then when you're targeting 1,000 pips on all of those positions or more, that is how money is made, because you're letting price run and then you're compounding. And through compounding, 1,000 pips can leverage to 2,000 or 3,000 pips. Okay, so let's have a look at this. If we open the weekly time frame, and I'm starting on the pound dollar. So what we'll do is we'll start going through each of these, well, as many as I can. I've got about 10, 15 minutes, as many of these pairs as I can. And let's start thinking about where potential exit levels would be on this, okay? So we can see quite clearly that price is up. Okay, now price is above the pink lines. Now the pink lines here are last year's high and closing price. So this is the high of last year and this is the closing price of last year. When I say closing, I mean December 31st, 11:59 p.m. That's the closing price, okay? And what we had was a break above and then a pullback to retest this level. We had a tram tracks formation and then price used this as a support level and it's bounced up. Now, where is it finding resistance? It's finding resistance at 1.7. Now, we should know this, of course, because the pound dollar is all over the news at the moment, okay, with 1.7. Is price going to break through? Is it going to bounce? Now, you can see here we've got a reversal candlestick. Now, reversal candlesticks only mean anything at extreme levels. So you can see here we've got a reversal candlestick at a strong resistance level. And if I actually compress price, you can actually see how strong this whole level is. I mean, this is going back to 2009. So you can see that, on 1, 2, maybe 3 here, it's not exact science, 4, 5, on several occasions, it's come to retest this whole sort of zone and it's failed. So what we are looking for is a break and a close above this pivot level here, which is 1.7043. So we need to see price break and close above this level here. Okay, once we've got a break and a close above that level, we need to see green XTL bars suggesting further strength. We are above the daily 200 moving average, as we already know. So that is suggesting a bull market, and we should see Get Stochastic keep on producing these false bars. Now, what's the target? Remember, the future of price action lies in the history. Okay, now that doesn't mean that it's guaranteed, but we can use past history and purely technical analysis. Forget the fundamentals. We can use purely technical analysis to determine key target levels. So what's happened in the past, there's a very good chance it can happen again in the future. It's not guaranteed, but there is a very good chance. So if we get a break in the close above this level, and you can see here how quickly price moved. If we get a break and a close above this level, there's a very good chance that price is going to head towards the first round number, which is 1.8. Now, we would like to see price break 1.8 and head towards 1.9. We would then also like to see a break of 1.9 and price head towards 2. And ideally then 2.1, as this is a major high. So what you're looking at, if we get a break and a close, is 1, 2, 3, 4, potentially 4,000 pips worth of movement. And that's not to say it can't happen. Remember, the longer the consolidation, the bigger the breakout. And this has been in consolidation for quite a long time. Okay, there have been trends within that consolidation that we could have traded. But the fact is that that is a long-term consolidation. When it bursts out of this consolidation, we should see this move very, very quickly. So target levels, 1.8, 1.9, 2, and 2.1. Okay, now, of course, the question then comes into how do you manage your stops? I'm going to do that on another webinar, okay? We're going to be focusing purely on target levels and where price can trend towards, okay? Let's move on to another currency, right? Let's look at the Aussie dollar because there have been some movements on some of the Aussie dollar crosses today, okay? Let's start with the weekly time frame. Now, you can see that the price is up, okay? We are below the weekly 200 moving average. Now, okay, how do I, there's a question that's come through which is based on my fundamentals. Guys, look, fundamentals have already been factored into price action, okay? And you can sit in front of your screen and take that into consideration if that's part of your trading plan. But in 8 years of trading, I can tell you that fundamentals generally just cause, all of these news releases that come out, a lot of it is just intraday noise. Okay, so I do not really take fundamentals into consideration. There's only one piece of news item that I take into consideration, and I'm sure lots of you have seen my tweets about it, and that's NFP. Non-farm payroll comes out on the first Friday of every month. And the way I deal with it is very simple. What I do is I switch my computer off on the Wednesday before. So Wednesday, Thursday, Friday, no trading. Monday, back to normal. I don't get caught up in the intraday noise. Let's look at this week's example of NFP. Yeah, just to take that into consideration. All right. So NFP, what we're looking at Monday. So this is Friday, Thursday, Wednesday, Tuesday, Monday. Right, this is NFP Friday. It's just a little bit of noise on the long-term trend, which is up. So for me, technical analysis tells us everything that we need to know. Now, I do take fundamentals into consideration when I am trading, when I'm investing into stocks, and that's a different portfolio and that's a different approach. But here we are trading. And as private traders, technical analysis tells us everything that we need to know. Okay, I hope that answers your question. Okay, so target levels on the Aussie dollar. Okay, no problem, you're welcome. Right, we can see that the trend is up. Let's look at the first target level. If price breaks above this pivot, where is price likely to head toward? Well, remember I said the previous 2 years I take into consideration. So the first target level is this pink line. So this will act as an area of resistance. If we get a break in the close above, then most likely price is going to head towards the weekly 200 moving average and the figure 1.0. Now this is a major round number. If we get a break in the close above that, then potentially price will head towards these pink lines here, towards 1.10, and ideally beyond that 1.2. So the Aussie dollar, what we should be engaging here is that the Aussie dollar does not have an easy ride ahead. There are plenty of resistance levels for price to handle, for price to deal with before we see a break above this high and a continuation of the bull trend. So if you are looking to get into the Aussie dollar, make sure your targets are well placed and that you can eliminate risk before any of these resistance levels that price has to deal with. Okay, let's go to the Aussie dollar, Canadian dollar. Again, start with the weekly time frame. What we can see is we had a move up to the upside. Now, where did price bounce? Well, not exact science. There's 0.9. So that's a round number. Okay, so ideally, I'll come back to that question on the Aussie dollar. Okay, what we had was price fail at this level. We had a sort of tram tracks formation, not exact. Remember, it's not always an exact science. Price moved up to the weekly 200 moving average. Here's a good example of how it acted as an area of resistance, bounced to the downside. This is where price closed last year. Reversal candlesticks, support level, bounced to the upside, price broke through. Now, look at what price is doing. It's basically wedged between the pink line close of last year, not last year, of 2012. And it is also using the weekly 200 moving average as an area of support. What we need to see is a breakout of this consolidation. So either a break to the upside or a break to the downside. I can see some questions coming through. I will answer them. Okay, let me just get through this analysis. So if we get a break above this, now look at this. The weekly 200 moving average is in close proximity to the figure 1. If we get a break above this, then what we should do is see price head towards the high of these last year and the high of the year before. If we get a break above this, then we should see price head towards 1.1. So again, target level should be based on, for me personally, based on the highs of the previous 2 years on the Aussie dollar, Canadian dollar. So if price breaks 1.03, then you're looking at about 400-500 pips. A break above that, another couple of hundred pips to 1.1. And then beyond that, 1.2, 1.3. So if we compress this, you can see that we did have an all-time high around this level here. So if we get a break above this high, then we should see further strength. Now, people do question me how I, go long on tops and go short on bottoms. Well, I don't go long on tops and go short on bottoms. I wait for a close above. A close above can only mean further strength. And a close below can only mean further weakness. So I'm not predicting, I'm letting price dictate what to do. And that's that's a key point to trading. Don't try and predict what's going to happen next. Let price dictate. Okay, so a break above this pivot high, and we should see strength to these pink lines. Okay, let's have a look at the Canadian dollar Swiss franc. Okay, I'm just going to choose currencies at random. By the way, guys, if there's any currencies like me to have a look at specifically on a purely technical basis, then please put them in the suggestion box and I'll happily do that. Okay, weekly 200 moving average. We're below the weekly 200 moving average in this case. So we are acting as, okay, thank you. This is acting as an area of resistance. We're also below all the pink lines. Okay, so the pink lines are now acting as areas of resistance as well. So now that we don't have to take those two sets into consideration as support levels, as we are looking for shorting opportunity, what becomes our next area of support? Now look at price. Where is price? Price is actually at the round number of 0.80. Yeah, so this is a major area of support and resistance, and you can see that price is struggling around here. Now what could potentially be being formed is a double top. A double top in a downtrend when this neckline is broken. So if we get a break and a close below this support pivot, a double top means a continuation of the downtrend. So here's a key fact. A double top in a downtrend is stronger than a double top in an uptrend. And the other way around, a double bottom in an uptrend is stronger than a double top in an uptrend. Okay? So now that we've got a double top in a bottom trend, potentially a break below here, target level will then be 0.7. So that will be a good 800 pips to 0.70. So plenty of space to have multiple positions and really let that 800 pips leverage to, 1,500, 2,000 pips, depending on how many positions you can open. If I compress the price data, you can see that this is an all-time low. So if price does break 0.7, then we should see weakness to 0.6. Okay. Now, if we look at the daily time frame, just to get an idea of what the daily time frame is suggesting, it's telling us pretty much that we're in an area of consolidation. So you can see here, this is where we traded and price handed out a lot of profits. So this is going back to last year, middle of last year. And you can see that this is a very good trend where price handed out very good profits. Okay, now after every big move, there's an area of correction and then further weakness. So basically you want to close below this pivot on, it doesn't matter whether you're looking at the weekly or the daily. I look at the daily for entry points. So a break and a close below this pivot on the daily time frame will close below this, will mean a close below 0.80. I would then want to see further red XTL bars, and I want to see a false bar reading. You're welcome. I want to see a false bar reading here, so a black line. So again, nothing on here, a bit of patience. Intraday traders, okay, you may be doing a different approach, but remember, I'm not an intraday trader. I'm a trend trader. It's a very, very different approach, okay? It requires patience, and it actually takes about 15 to 30 minutes a day. So it can be incorporated into your lifestyle. You know, if you have a 9 to 5 job, you know, you need a style of trading that can be adapted around your lifestyle. You can't be day trading at all if you are working 9 to 5, 9 to 6, even longer than that. You guys need to be people need to be smarter with their trading. Okay. Right. Now, I have seen some very good suggestions coming through. The first suggestion that came through was the pound yen. So let's have a look at the pound yen. Okay. Now, okay. So what you can see here is a very good example of the trend. Now, we know that the trend is your friend. At the beginning of the year, so the beginning of each year, usually what happens is a reversal against trend. So what we're looking at here is January of this year. Okay, and at the beginning of this year, we had a move against trend. And where did price pull back to? Well, approximately a round number, not exactly, but close, right? More 1.64. But we had a reversal candlestick at this level, and price has since headed up. Now, look at what price is doing. It's just basically consolidating. We've got these pink lines acting as an area of resistance, and we've got the pivot low acting as an area of support. What we need to see is a clear breakout. Now, as the trend is up, that is the direction that we want to be trading in. So a break above these pink lines, a break and a close, not just a spike. We want a break and a close above these pink lines. We should then see further strength towards the 180 figure. And ideally beyond that, 190, 200, 210, 220. You can see that there's plenty of space for price to move because it's happened in the past. Doesn't mean it's guaranteed, but there's a very good chance that this can happen. So if we get a breakout of this area, then we should see further strength. If we look at the daily time frame, you can see that price has had green in the past, suggesting strength. But look at what price is doing now. It's just range bound. There's no trend on here. There's no volatility. There's no momentum. You want to be staying out of this market until we get a break of this pivot high. A break and a close of this pivot high. We get false bar reading or get stochastic. Everything suggesting further strength. There's nothing on here for now. So targets. Your target for now is to stand aside till we get a break in the close, then target 180, target 190, ideally 200. Okay, euro dollar. I think someone suggested that. So let's have a quick look at the euro dollar. Of course, the euro dollar is always all over the news. People like to trade it. It's the most heavily traded currency. But if you can see that basically price is wedged between the pink line high and the pink line close of last year. The pink line high is in close proximity to figure 1.40, as I'm sure most of you know. What am I doing on here? Well, I'm sure you guys can guess by now is that I'm standing aside because there's no trend direction for now. We did have a trend. We did have a trend here, but since then, it's just been very difficult to engage in a clean trend. If we get a break above 1.40, where is price going to head towards? Yeah, 1.5. Okay, 1.50. So that's 1,000 pips. That will give us plenty of space for price to move and most importantly, to compound. So 1,000 pips can leverage to far greater. Okay, if we get a break above 1.5, then we can target 1.6, which is a previous high, and then ideally beyond that 1.7, 1.8. You know, but these will be major resistance levels. But based on where price is right now, we've got 1,000 pips, then we've got another 1,000 pips. So it's potentially 2,000 pips worth of movement. That is, of course, if price breaks up to the upside. If we go down to the daily time frame, we are above the daily 200 moving average. But look at what price is doing. Black XTL bars suggesting range. We did have a bit of excitement on Thursday last week where price came towards 1.4, but then the sellers really came in strong. So again, the day traders, you can see red bars. You can see the day traders are really trying to pick the top of a trend. But in reality, this move here is a small move compared to what is the overall trend, which is up. Yeah. So, you know, it's not something that I tend to, you know, these sort of intraday sort of moves, trading ranges is not something that I tend to do a lot of. Okay, I can see some other questions coming through. I will look at one more currency. I can't remember which one it is. Let me just have a quick look up. Okay, the Swiss franc. Okay, let me go to the Swiss franc. That is a good suggestion. Okay, so let's have a look at the Swiss franc. Again, I'll start with the weekly time frame. We are below the weekly 200 moving average, so that's acting as an area of resistance. Okay, now the pink lines you can see here are the pink lines acting as resistance, but look at these pink lines right here. If I just expand price action, you can see that price is basically wedged between the pink line close of last year and the pink line low of last year. So price is stuck between this as support and this as resistance. Now it has broken a couple of times, but it's really finding comfort around this area. What we need to see is a break and a close below this pivot for further weakness. And then we need to see a break and a close above 0.9, which is a round number for further strength. Then price will head towards the weekly 200 moving average, and then ideally above that to the figure 1. Okay, now if we go down to the daily time frame, excuse me, let me load up my XTL bars. Okay, if you look at XTL, it's pretty much black. Again, no clean trend direction. So what we need to see is price break and close below this pivot low. And then we should hopefully see further weakness towards 0.8 and 0.7. And you can see that 0.7 was a previous area of support. Okay, so we really need to see a breakout of this range. Now, remember, the longer the consolidation, the bigger the breakout. So we had this huge trend. This trend started, in 2010 all the way down to 2011. So, over a year-long trend. So after a big move like that, you do expect some kind of market correction and consolidation. This is really consolidating between 1 and this resistance support level at 0.85. So what we need to see is a breakout of this. And, the odds are very much with the bears at the moment. If we get a break out of this whole support level, this whole area of consolidation, then we should see further weakness. Okay, I hope that makes sense, guys. So in summary, target levels, what you're looking at are, okay, so weekly 200 moving average, area of support and resistance. Daily 200 moving average gives us a bias, a bull market and a bear market. XTL bars, green for further strength, red for further weakness, black to stand aside. Get stochastic, we're looking for the false bar reading. False bar reading will say continue in the direction of the trend. Don't go overbought, oversold, go in the direction of the trend. Now, round numbers, they are our target levels. Okay, so round numbers act as areas of target. So going back to the title of the webinar, systematically place target. The answer lies in the round numbers. Those are the numbers that you should be targeting. So when you are in a trade, have your first target, which allows you to eliminate risk, and then try and let that trade run until you start approaching round numbers. Okay. Okay, can you still see my screen? Yeah, I haven't lost sound. Can you still hear me? Yes? Okay, great. Okay, thank you. Right, let me quickly go through some of the questions. I believe one of the questions was, what is my risk to reward? My risk to reward is 1-to-1. Okay, my risk to reward is 1-to-1. But crucially, when price hits my target level, I don't close my position. What most people tend to do is bank profit. Now, it's human nature to, as soon as you get profit, bank that. And then, as and the reverse side to that is when you are in a loss, you try and hold on to that loss for as long as possible in the hope of recovering your money. You've got to reverse that logic. When you're in a winning trade, you want to keep that open for as long as possible. Stay in your winners. So what I do when I hit my target is I just simply eliminate risk. So my stop could be 300 pips. My target will be 300 pips. When I hit my target, I move my stop to entry. I then let my trade run for as long as possible. Okay. The platform that I'm using is at eSignals Advanced Get. Okay. It's the best, for me personally, it's the best charting package. Not only is it clean and simple to use, it allows me to have my own, our own unique tools and strategies that we have programmed into eSignal. eSignal allows for that. So the functionality of eSignals Advanced Get cannot be beaten. Yeah. I won't disagree with that. What you mean by trades come to us versus looking for trades? Okay, what I mean by that is having a criteria, a confluence of events. So looking at my software and the setup that I have in front of me, if I'm looking to go short, I'm looking for price to be below the daily 200 moving average. I'm looking for red XTL bars. I'm looking for get stochastic to give a false bar reading at the bottom. I'm looking for weekly to be below the pink lines, below the weekly 200 moving average. So I have a checklist. I have a certain criteria. If that checklist is not met, I don't take the trade. And so that's what I mean by letting the trade come to me and not me chasing the trade. You know, I don't get caught up in that intraday noise. If you look at, for example, Friday is a perfect example. There was a big move up on a lot of currencies or a big move down on a lot of currencies. But by the end of the day, it had reversed and become like a long wick reversal candlestick. I'll give you a good example of that. The pound Canadian dollar is a very good example of that. And if you look at what happened on Friday, you had this big move down and then a big move back up again. It's just intraday noise. In reality, this market's in consolidation. So it's not something that I would particularly want to be trading until I get a breakout to the upside. And then I will be targeting 1.90 and then 2.0. Okay, so patience is key. Where can you learn about checklists? Look, again, it's a difficult question for me to answer. You know, if you really want to learn about trading properly, you really need to get the right information. And the only people that will give you the right information are full-time traders. You know, brokers, you know, there are good brokers out there, but you're not going to get the information that you need from brokers or people that are, I don't know, from certain academies. Or you gotta do your research. You gotta find a style of trading that suits you. You got to know, you know, there's got to be an element of trust in that person that you are, you know, looking to teach you. But like anything else, you need to get proper training. Okay, anything that's free on the internet generally doesn't have the value you're looking for. So question, so it takes a lot of patience. Yes, it does. Guys, I haven't pulled a trade in foreign exchange since January. Yeah, I haven't pulled a trade in foreign exchange since January. But that doesn't mean I'm not trading. I've been trading stocks. I've been trading other markets. I just haven't traded foreign exchange because there's no momentum. And you can see that with the black XTL bars here. You need to have large areas of trend. I have got positions running on here. I've got 5 positions running on here since September of last year. And I've got positions with profit locked in of around 5,000 pips. But I haven't traded this since January. And you can see that with this reason here. It does take a lot of patience. Yeah, but that's a good question. It says, with your type of trading, you might be down. Guys, do not expect a trade to shoot in your favor. That's another misconception. When you enter a trade, it's very rarely just going to shoot in your favor. You know, that's why people scalp and day trade, because they're looking for quick profits. When you've got a stop loss in play of 300 pips and only risking 1%, then you know, it doesn't matter where price gets against you. It's not a hair-raising ride. You know, it's not a scary ride because you're only risking 1%. But there's a very good chance that price will go against you first before going in your favor. And that's natural market movement. That comes with understanding. That comes with faith in knowing what the education that you have. What minimum account need for you? Okay, what do you need? I would say a good starting point is about £2,000 in a micro account. So you're trading with like 10p a pip, 8p a pip, 1p a pip, whatever. The exotics are now 1p a pip. But you have to still remember, even with £2,000 in an account, you can still see returns, very good returns. If you have £2,000 in an ISA or a SIP, you're getting 1% from the bank here in the UK, 1%. Whereas with £2,000 in a micro account, you can still see returns of 20 to 30% in your first year. In your first year. Beyond that, you can see excellent returns. I mean, there's people in our trading community who saw returns of over 90% last year, but they've been doing it for 2-3 years because they understand, they're confident, they know how to compound, they know how to stand aside, they know what trades to take, they know which market to be in, they know which market to stand aside from. There's a whole art that comes with trading. It's not just in and out, in and out, in and out. You know, 10 grand into $1 million in 6 months, you become rich. But you know, you've got to be logical. It takes time, it takes trading, it takes understanding. Okay, guys, look, that I've run over my time. You know, I'm 5 minutes over. I'm sorry, administrator. I'll just quickly go through my stuff that I have online. Please visit my website, which is thetraderscosmos.com. The Huffington Post. I write for the Huffington Post. I was asked to write for the Huffington Post, guys, because of what I do, the unique approach that we have, you know, long term. Okay, so I write for the Huffington Post. Some of you guys may have seen my YouTube channel that gets updated all the time. I put up the euro dollar today. Twitter, please follow myself and Dean, who is the CEO of the Traders Cosmos. Okay, and finally, guys, you know, if you are interested, please get in touch. We do have a special offer for people that do get in touch with us and do want to take part in our community and get the right mentoring. Okay. We are looking to take people on and we are looking to expand. It's a very bespoke product. Training is all one-to-one. We're not looking for 50, 100, 1,000 people in one room. We're looking for serious people. Now, remember, only 5% end up actually doing well in this. So please be part of that and do it properly. Okay, guys, have a great day ahead of you and speak very, very soon. Take care. Bye-bye.